Hey, don't let retirement sneak up on you. What you can do right now to make the most of those golden years.
Okay, so we are in the thick of tax season and we are taking action. We want to make sure that you get all of the money that you're owed. So we've got CPA Bob Hockensmith here with us. And Bob, we are talking about retirement today. Right. What are some of the key points that people need to think about as they're filing when it comes to their retirement?
Well, one of the things that people forget is that when you first put money into a retirement account, like let's say you haven't done it for the last couple of years, and now you've decided, okay, I'm going to start saving for retirement. The government will actually give you a credit on your taxes for putting money into a retirement account, up to $1,000 if you're single, up to $2,000 if you're a married couple. So you can actually put money away into a retirement account, have it put away for the future, and the U.S. government will give you a check for doing that.
Yeah, double bonus. That's nice. What do you recommend as far as how much people should be contributing to their 401ks?
The maximum, the best, is the optimum is 15% of your gross income.
Okay.
If you can put away as much as 15% of your gross income, that is the best situation to be in.
Okay, and I know that sometimes employer matches come into play here.
And that's free money.
Yeah.
So if you put money away, let's say you put 3% of your check away. The employer can match 3%. You put 4%, your employer can match 4%. And most employers will match 4 or 5%, no more than that. But you get free money every time the employer helps.
Yeah, take advantage for sure. What about IRA contribution plans? Are those kind of a different beast than the 401ks?
Yes, you get the 401ks, which are sponsored by your employer. Then you've got an IRA, which is something you can choose to do whether your employer puts it together a plan or not. The IRAs are $5,500 if you're 50, excuse me, if you're under 50.
Okay.
$6,500 if you're 50 and older. And if your spouse doesn't work, but you do, and you earn enough to contribute to both IRAs, you can have one person working in the family, and you can put 2 IRAs away and get a tax deduction for it.
Oh, wow. So it seems like there are some options there for sure, depending on your situation. Now, you mentioned, you know, if you're 50 or older, ideally you've started saving for retirement before then, but if you haven't, you talk about something called the catch-up plan. What do you recommend for folks who are maybe on the older side as they get going saving for retirement?
When you're 50 or older, the employer contribution catch-up plan is usually about $5,000 or $6,000. So if you're under 50 this year, you can put away $18,500.
Okay.
If you're 50 and older, you can put away $24,500.
Wow. Okay.
A lot more.
Yeah.
And with the IRAs, it's $5,500 if you're under 50. If you're 50 and older, you get an extra $1,000 pop, so you get $6,500.
Even better. Yeah, we'll take it for sure. And real quick, there are some new investment limits. What do folks out there need to know about that?
Well, the new investment limits are, for 2017, it was $18,000 that you could put away if you were under 50 for a 401k, and $5,500 for the IRAs. For 2018, it's $18,500 if you're under 50, $24,500 if you're 50 and older, and the IRA gets an extra $1,000 bump on top of that.
All right, a lot of things to think about come tax time. Thanks, Bob, for helping us sort through all that.
Always start soon.
Yes, we appreciate that.